So let's pass that real estate exam. How? Practice lots and lots of questions, and also, of course, the vocabulary. Lots of videos on one of the vocabulary playlist. And remember to participate during class and ask questions, type the question number and the letter answer. For some reason, if you get it incorrect, I will help you get to it the right way and to understand it. Anybody watching the replay, this class is designed to, it seems a little bit darker today, to have students participate during the webinar. So you can fast forward at any time. Okay. Hi, Fabiola. Hi, Anna. So let's get with it, y'all. Okay, so this is the book that we're using by Medling out of the East Coast, actually out of Florida. So they had to deal with the Florida hurricane and flooding and all that. So we're continuing on with national questions today and also then Texas state questions. So we're starting out with question 711. Hey, I like those numbers, huh? 711. My family likes to gamble in Las Vegas, right? And wouldn't you know it that, well, you don't know it. However, just a quick little story here. On my father's headstone, there is the dice on the left side, okay? 711. And on the right-hand side, the poker cards, ace to the 10, because my dad used to love to gamble, and there were times that he would make a lot of money. On my mom, so 711, since I'm the seventh child, that's some of my favorite numbers. And then on my mom's tombstone, she had a yellow rose of Texas, and because we are from Texas, and then also the Bible and the rosary because we grew up Catholic. So very interesting how you never think about seeing a 711 on a tombstone. All right, so here we go. What is a loan to value ratio? Okay, a ratio, a percentage, it's a number. So A, the percentage of a lender's portfolio that is composed of mortgage loans. B, the ratio borrowed principal plus total interest to the appraised value of the collateral property. C, the ratio of a lender's return on a mortgage loan to the value of the collateral property. Or D, the fraction of the appraised value of the property offered as collateral which the lender is willing to lend. Type your answer in the chatty chat. And I'm refreshing my Facebook page and the YouTube since I am streaming to both. And so who knows, hey, later on you may get, once you're into real estate, you might create videos, have a streaming channel, a podcast. You want to make sure you get onto all those social media. Not what I liked, however, I use them all. All right, 7711. Hey, I like that 777. No, it is not B, Anna. So take another attempt. It is a ratio. It is a percentage. However, that's the ratio of borrowed principal plus total interest. No, loan. Okay, loan to value of the property. So the lender is providing a loan, and according to the appraised value of the appraisal, okay, not of the offer, not of the listing, but of the actual appraisal, right? When they're going through the final approval process after we have an executed contract, the contract goes to the lender and the lender starts to approve the borrower, and they want to make sure that that property is going to have a good value, that they will get their money back. So if they're loaning 80% out of 100, so the loan to value is going to be a ratio of the loan amount and the actual value of the property. So they're actually going to loan 80%. Yes, the answer is D. The fraction of the appraised value, darn it, of the property offered as collateral, right? Because the property is the collateral. That's the subject property, which the lender is willing to lend. No, it is not the A. It is D. You have it right, Ruth. 711 D. You were right. Or you are right. You changed it. You doubted yourself. Right? You doubted yourself on that. So the answer is D, the fraction of the appraised value. So the lender is going to loan on an 80% loan. They're loaning 80% of the appraised value. So that's the first process that they do, is approve the borrower, and then they get an appraisal, and the home is approved, and then the survey. So 711D. National questions and answers. Okay, number 12. The difference between what a borrower has to pay to purchase a property and the amount a lender will lend on the property is the A, mortgage insurance coverage amount, B, lender's profit margin, C, buyer's down payment, or D, origination fee. So the difference between what a borrower has to pay to purchase a property, okay, and the amount a lender will lend to the property is the, type your answer in the chat. So most individuals, unless they're veteran, when they're borrowing a loan to purchase a property, they've got to have some money, right, in addition to the loan, and then of course also closing costs. Yes, the answer is C, buyer's down payment. So if it's an FHA, Federal Housing Administration, it is 3.5% down. They can put more down than 3.5%, but that is the minimum requirement, 3.5% down. If it's a VA is 100% guaranteed. However, the borrower can put a down payment to reduce their monthly payment. And if it's a conventional, it could be 5% down payment, 10, 15, 20. It used to be 20% minimum. However, during a challenging market, they made it 5% minimum, which helps a lot of also investors, even though investors usually have to put 10 to 15% down or even more when they're buying multiple properties. Okay, so very good. C on that. All right, that's not going to work. Gee. Okay, I'm getting there. Bear with me. Okay, number 13. The Equal Credit Opportunity Act. So Equal Credit Opportunity Act prohibits a lender from doing what? A, refusing a loan because the borrower does not match the lender's target market. B, including income from self-employment if the borrower's qualifying income, C, requiring both spouses to sign the loan application, or D, refusing a loan because the borrower has a defective credit report. So Equal Opportunity Act, Equal Credit Opportunity, not employment, but Equal Credit Act prohibits a lender from doing what? No, it is not a D. The lender can refuse to provide credit because they have a bad credit report. So that is true. But which one are they prohibited to do? Okay, they can't be prejudiced, right? So yes, Fabiola and Anna, the answer is A. Refusing a loan because the borrower does not match the lender's target market. Their target market is, they only want high-end borrowers, have lots of money, lots of different good credit. Well, they can't do that. Or only in a specified area. So the answer is A. You get that, Anai? Oh, I forgot to say hi, Anai. So if I haven't said hi, let's see, Ruth, Fabiola, Anai, Anna are here. Okay, number 14. Did you get that, Anai? You chose D, and they can refuse based on low credit. Okay. All right. Number 14. A loan applicant has an annual gross income. Okay. Annual, pay attention, gross income before deductions of $72,000. How much will the lender allow the applicant to pay for monthly housing expense to qualify for a loan if the lender uses an income ratio of 28%? And lenders will go on the gross amount, and then they start deducting, looking at what other credit they have, not the usual utilities and that type of thing. Okay, Anai, I'm glad you did. So gross income of 72,000, and the lender uses an income ratio of 28%. Okay, so first you have to do what? You do it by monthly income, right? Because they have a gross income. So divide that by 12, and you're going to get what? 6,000, right? So it says it's a gross income, and then pay monthly housing expense. How much can they qualify? Allow the applicant to pay monthly to qualify for a loan if it's 28%. So you calculate, you divide it by 12. Okay, and then you multiply by percentage, move the decimal back 2 spaces, 0.28. And you come up with B. Way to go, Ruth. 1680. Yes, 72,000. No, not times 12, divided by 12. You got the right answer, but it's divided by 12. Maybe that's what you meant. It looks like times. So divided by 12 and then times 0.28, 28%. Yes, Cindy, you got it. How's it going? All right, number 15. I kind of thought though, Ruth, because you got the answer right. So, put a slash, right, for divide instead of the asterisk. Okay, 715. AMC Bank discovers in considering Bob's application for a mortgage loan that Bob has borrowed the down payment from an uncle and has to repay that loan. Bob should expect that AMC Bank will do what? So, banks will allow certain things. They'll allow a gift, However, if they have to have other loans, that could be an issue. A, refuse the application. B, adjust the applicant's debt ratio calculation and lower the loan amount. C, increase the loan amount to enable the borrower to pay off the loan to the relative. Or D, require the borrower to make payments to an escrow account for repayment of the relative's loan. So what will the lender do, or what can the lender do in order to provide a loan to that buyer? Because remember, they look at all the debt that a borrower has, and they can change, okay, the debt to income ratio. That's different from loan to value. I'm talking now debt to income. I'm stuck between B and D. Well, get unstuck. It's not D. Okay, the answer is B. Adjust the applicant's debt ratio, debt to income ratio, and lower the loan amount. Because of the fact that they borrowed a down payment from their uncle, so now their debt increases, right? And they've got to pay more. And therefore, the lender is going to reduce the amount of money that they can loan them to purchase a property. So now they'll have to purchase a less expensive property. Now, if that loan if it had not been a loan but a gift from the uncle, then that would have been okay. The lenders will allow a gift, and it has to be in the account for a certain amount of time. So the answer here is B. Adjust the applicant's debt ratio calculation, okay, and lower the loan amount. So D says require the borrower to make payments to an escrow account. Well, they're going to require that if they have a loan greater than 80%, okay, then the lender is going to require an escrow account. And what's that? Like a little savings account to pay the property taxes and the homeowner's insurance, and not to repay the relative's loan. Lender doesn't get involved with that in managing that loan unless they were to provide a consolidated loan, but that's not what they're doing here. So that's why it is not D. Borrower needs to handle their own repayment of the loan to their relative, to their uncle. So you're doing good. You got unstuck, right? All right, number 16. The Federal Reserve's Regulation Z applies to which loans? A, all loans. B, all loans secured by real estate. C, all loans secured by a residence. Or D, all loans over $25,000. So Regulation Z applies to what kind of loans? Now, it can't be all loans, okay? Oh, no, it is not D, Fabiola. Take another. So it's not A and it's not D. Yes, residential. So all loans secured by a residence, right? Because they're protecting the consumer. Almost type B. It's not necessarily just secured by real estate, because real estate could be commercial real estate, agriculture, industrial, residential, multifamily, which would be commercial if it's greater than 4. So it has to do with all loans secured by a residence. Got it? So it is residential, but not all, because what if it's a multiplex, right? An 8-plex, that becomes commercial. So a lot of the laws and regulation are there to protect the consumer of 1 to 4 family, 1 to 4 residential family housing. Okay, not commercial or anything other than 1 to 4 family residential. Okay. So remember, does not apply to agricultural loans over 25,000. Its provisions cover the disclosure of costs, the right to rescind the credit transaction, advertising credit offers, and penalties for non-compliance with the act. So that goes with the advertisement that lenders have to follow. All right, 17. If a particular loan falls under Regulation Z's right of rescission provision, okay, right of rescission provision, A, the lender has a right to change the terms of the loan within a certain period. B, the lender has a right to accelerate repayment of the loan because of the change in the borrower's credit status. C, the borrower has a right to pay off the loan ahead of schedule with no penalty. The borrower, okay, or D, the borrower has a limited right to cancel the transaction within a certain period. So Regulation Z's right of rescission. What can the borrowers do under that Regulation Z? So it's a right that the borrower has. All right, so far I have D from Anai. Anybody else? There are many of you on here. Come on, I invite you to participate. This is where you practice, practice, practice. Now, if you're driving, please do not be texting. I'm guilty of it. However, we don't want to do that, okay? Many accidents happen. Yes, the answer is D. The borrower has a right to cancel the transaction within a certain period. Okay, that the particular loan falls under Regulation Z's right of rescission. So during the purchasing process, okay, of a purchase and sale agreement contract that has been executed and it's going through the closing process, they can rescind their transaction. They can terminate it. Now, they may lose their earnest money to the seller. It depends, okay? Okay, very good. Number 18. Under the Equal Credit Opportunity Act, Equal Credit Opportunity Act, a lender or a real estate agent who assists a seller in qualifying a potential buyer may not do what? Okay, so they cannot do one of the following. A, tell a rejected loan applicant the reasons for the rejection. B, ask the buyer borrower about his or her religion or national origin. C, ask the buyer borrower to explain unconventional sources of income. Or D, use a credit report that has not been provided by the borrower. So under the Equal Credit Opportunity Act, a lender or real estate agent who assists a seller in qualifying a potential buyer. Okay, so the buyer is a prospect at this point, right? All right, yes. So, fair housing, right? You can't ask about the B, ask the buyer borrower about their religion or national origin. Very good. Thank you. And yes, I'll ask Fabiola and Anai to go ahead and please type in the question number in addition to the letter answer so that we are all on the same wavelength, the same page as far as which question is being answered. because I sometimes get confused. So which one? Because there are delays on here, to Facebook and to YouTube. There could be, 5 to 10 second delay. I better type the right answer. Which one is it? I'm on number 17, right? No, I'm on number 18. Okay, 18B. All right, so 718B. Very good. Okay, so Lenise, hello everyone. I finally got the live. Awesome. Lenise Interiors. Hey, so now that I noticed, Lenise Interiors, remember, all of you want to have a Facebook page, a personal Facebook page. And when you start your real estate business, then you'll create a business page. And it is your name. And I would say, do not put the broker name on there, because if you happen to change brokerage, you know how long it took me to have Facebook allow me to continue using the Facebook business page where I had 1,500 followers? It took like 2.5 years. They kept denying me. So put your name, put your phone number or the company name that you're going to use, and then put the broker information on the description below, not on the actual Facebook page name. Wow, it created a lot of issues for me. I had to start another one. Okay, let's see. I want to thank you for your help with me passing my exam. Awesome. Which one did you pass? And then Juan Sandoval, they are eliminating all realtors' Facebook pages and also for car Loya or car sales. Yeah, there's a lot of changes coming along. That's why I'm glad I also have YouTube. And I have referred some other students. Awesome. Thank you. And I've started posting some shorts today, okay, that will direct individuals to certain videos. So I'm learning more stuff. Yeah, that's interesting, Juan. A lot of changes have been made and are continuing to be made. And the advertising platform also on Facebook, there are some major changes. Okay, however, when it comes to advertising on Facebook, we advertise on a business page and not on a personal page. So maybe they'll change that. So, oh, look at that. Lenise passed her national. Yoo-hoo! All right, yay! I wish I had a bombs, or what do you call it, pom-poms, to celebrate. I'll have to get some. So congratulations, Lenise. So one says starting 2023. So that's in 2 years. Oh, you're now a licensed realtor. Woohoo! Who did you join? Oh my gosh, Lenise, you didn't come talk to me about eXp Realty. Who did you join? You're very welcome. So I'm curious because I am a realtor looking for individuals to evaluate eXp. So look at that, y'all. She's now a licensed realtor. Okay, awesome. Because remember, when you pass, you have an inactive license. Once you select a broker, a sponsor, you become active. And when you join Exit Realty 360. Okay, maybe in the future, once you get your feet wet a little bit, I moved a lot of times, you might consider eXp. Oh, yeah, that's a good thing. Ana maracas. Yeah. All right, good idea. Okay, let's keep going. I get all excited. Number 19. A conventional mortgage is one that is conventional mortgage. A, backed by Federal National Mortgage Association. B, insured under Section 203B of the Federal Housing Administration Loan Program. C, guaranteed by the Government National Mortgage Association. D, not FHA insured or VA guaranteed. Yes, Lanice. When I started with Century 21. That was back in 2002 in Oregon, right? I used to pay 50-50 split. And then I'd go back to engineering, then come back. I went through a lot of different companies. They would get nervous when I would invest in real estate. And eventually, the last two companies I've been with, well, I had my own brokerage, okay, in Oregon, but I had a realtor assistant only. And I did a lot of short sales. So many of us move around after we get our feet wet and we find a better opportunity. So yes, keep us in mind. And I'd love to talk to you. And I'm so happy that you passed. Congratulations, congratulations. And I'm glad that you came on here to let us know and that the videos help from me and maybe others. Type on there a little disclaimer, not disclaimer, a little bit of information of what exactly you studied, how often you studied, and how many times you took the exam. Okay, so what is 719? No, it is not A. The best answer is D. It is not FHA insured nor VA guaranteed. A conventional note, no mortgage is not FHA nor VA. You have to pay, if it's greater than 80%, you'll have to pay, what's it called? PMI, private mortgage insurance. So no, it's the correct answer is not FHA insured or VA guaranteed. So the answer says a conventional mortgage loan is permanent long-term loan that is not FHA insured or VA guaranteed. Fannie Mae, Federal National Mortgage Association, does not back loans. FHA only insures FHA loans, and VA, not Ginnie Mae, guarantees loans. That's what FNMA is like, Fannie Mae, and Government National Mortgage, Ginnie Mae. Those are the acronyms or names for that. The genie in the bottle, right? But no. Okay, that was 18. Number 20, the assumability of an FHA loan, FHA insured loan, because remember, FHA is insured, VA is guaranteed, is A, unrestricted, B, limited by when the loan was originated, C, limited to owner-occupied properties, D, prohibited on all existing loans under current regulations. Type your answer in the chat. So there are assumable loans, so it depends. Okay, so far I have a B. Oh, I already typed the answer in. Okay, so didn't give you enough time. So yes, the answer is B, limited by when the loan was originated. And a person that is going to assume the loan, if the lender approves it, has to qualify for it. The lender has to approve them. So that was 719B. Oops. Oh, I typed 719. We're on 720. Oh, uh-oh. Hey, you all, whoever's watching the replay, I typed 719B. Yes, that was correct. No, 719. I need to correct that. Okay. I typed the wrong thing by reading others. So 719 was D. Okay. See, I have to be careful and read. You know, multitasking doesn't always work. 720 is B. Okay. So here's a comment by Lanice when I asked her how she studied. So she said, I studied daily for at least 2 hours. Woo, yeah, that's what I did. And I passed the state portion the first time. And 2 weeks later, after watching your lives and studying, I was able to do it. You're the best. Oh my gosh. Thank you so much, Lenise. You're the best for coming in here and letting us know and letting others know. Right. Look at that. She studied every single day, okay, for 2 hours, and probably studied her prep books and watched videos. And then 2 weeks later, she studied more and retook the exam. So that's what it takes. Study every day. That's exactly what I did. Studied every day. And oh my gosh. So anybody watching the replay, be careful with my answer right there. It is not 719B. I meant to type 720. It is 719D. Okay, so where is my 719? Okay, where is my answer for 719? God, I'm getting all confused here. 719 is actually D. So let's see, 718 with D, 719. So disregard the 719B as in boy. It is not correct. It is 719D. Conventional loan is not FHA insured or VA guaranteed. Okay, see, teachers make mistakes. And 720 is B. Assumability FHA loan is limited by when the loan was originated. So thank you, Lenise. Appreciate it. All right. Okay, we started with, what did we start with? 711. Okay, so we've done 10 questions. Okay, we're going to do 5 more. Number 21. A VA certificate of eligibility determines what? So first of all, it's for veterans, right? A, how long an individual served in the military. B, the maximum loan amount an approved lender can give to veterans. C, how much of a loan the VA will guarantee. Or D, whether the loan is approved to issue VA guaranteed loans. I'm sorry, whether a lender, not loan, whether a lender is approved to issue a VA guaranteed loan. So which one is it? How long they served in the military, the maximum loan amount they can approve, how much of a loan the VA will guarantee, and whether a lender is approved to issue VA guarantee loans or not. So y'all can read this question from Ruth to Lenise. So I'll let you know, Ruth. It is learn, memorize your vocabulary. There's a lot of vocabulary in the national, and practice lots of questions. But we'll let Lenise also answer that. You need to know your vocabulary, and that's a big weakness on that. Okay, so we have 71. I'd say C, B, C. I'm sorry, not 7. 71. Yes, number 71. 721 is C. How much a loan the VA will guarantee? Because remember, VA guarantees a loan. Thank you, Anaí, for typing the question number. So it is actually C. B says the maximum loan amount an approved lender can give to veterans. No. See, the VA certificate of eligibility. So first, the veteran has to apply with VA to get that certificate of eligibility before they can go to a lender. the VA will, since they guarantee it, they've got to determine how much of a loan they will guarantee for that particular veteran. Okay. So VA guarantees, FHA insures. You're very welcome. All right, number 22. All right, let's see. You don't have to apologize, Fabiola, even though I use the word sorry a lot. I know you typed 22 instead of 21. Hey, it's like me typing B instead of C or D. All right, 21. I'm sorry, 22. A borrower obtains a 30-year fully amortized mortgage loan. What is fully amortized? Okay, so who was asking the question? Ruth. Okay, so do you know what fully amortized loan is? Do you know what VA guaranteed, FHA insured? Do you know all those terms? And do you know what the principal amount is? Principal balance. So a borrower obtains a 30-year fully amortizing mortgage loan of $50,000 at 8% interest. What is the principal balance at the end of the loan term? It doesn't say, whether it's fixed or it's interest only. Okay. So we're to assume that since it's being amortized for 30 years, it is a fixed interest rate that's amortized the loan for 30 years. Most people will not buy an interest only property because they're going to pay on it for 30 years and they're paying only interest. So it doesn't make sense. So whenever you see a 30-year, 15-year amortized loan, they're amortizing a loan with a fixed rate, the principal and the interest. So what is the principal balance at the end of the 30 years? So the payments were stretched out for 30 years, right? 360 months, every month paying principal and interest. Every month they pay less interest and a little bit more principal until the principal becomes the majority of the payment and very little interest. So after 30 years of paying that loan, an equal monthly payment, but you start paying more principal and less interest, okay? What happens at the end of 30 years? The home is paid for. You now own the home 100%. Well, with the exception of property taxes. And unless you're a 100% disabled veteran, there won't be property taxes to pay. So at the end of the loan term, it is balance of principal is zero. Okay, paid it all 30 years. Nowadays, it's very rare for individuals to stay in the same home for 30 years. My older generation, my family, my brothers, sister-in-laws, yes, they stayed in their homes for 30 years and they pay off their loan, okay, in those 30 years, or make extra principal payments to pay it quicker. Did y'all understand that? Dang, numbers threw me off. Yes, I understand. Yes, you mentioned here, is it fixed? Okay, so I said common sense. When it's a 30-year fully amortized loan, it's going to have a fixed interest rate and the monthly payment is fixed every month. Even when an individual makes a large lump sum towards the principal, it doesn't change the monthly payment. That monthly payment stays until the 30 years or 360 months are up. And at that point, it's paid free and clear. Now, if they paid a major lump sum, then they're paying less interest and it's not going to last 360 months. They're going to end up paying it much sooner. All right, number 23. $722D. Yeah, those dang numbers, huh? Which of the following describes a purchase money mortgage financing arrangement? A purchase money mortgage financing arrangement. Ruth, do you know what that means? If not, vocabulary. Practice a lot of these questions over and over. A bank gives a buyer a senior mortgage loan that fully covers the cost of purchasing the property. B, the buyer gives the seller a mortgage and a note as part of the purchase price of the property. C, a land trust holds title to the property while the buyer makes periodic installment payments to the seller. Or D, the seller uses the purchase money obtained from the buyer's mortgage loan to repay the seller's outstanding loan balance. So it says, which one describes purchase money mortgage? So you're purchasing a property, you have a mortgage, and there's other things that go along with it. Type your answer in the chat. No one's answering. The answer is B. The buyer gives the seller a mortgage and a note. That's the security, right? The mortgage is the deed of trust. In the state of Texas and other states, it's a mortgage. And so the difference between the two is the foreclosure process. And a note. The mortgage is recorded, the note is not, as part of the purchase price of the property. Number 24. A homeowner borrows money from a lender and gives the lender a mortgage on the property as collateral for the loan. The homeowner retains title to the property. This is an example of A, intermediation, B, forfeiture, C, hypothecation, or D, subordination. Type your answer in the chat. Let's see. So far, I've got 24C. C. Yes, that is correct. Hypothecation. So it's the process of securing a loan by pledging a property without giving up ownership of the property is called hypothecation. So they have legal title, and the lender, they have a mortgage, right? They have equity title, right? So the trustee in a state like Texas that has the deed of trust, the trustee holds on to the title, right? The deed gets recorded. The deed of trust gets recorded. Okay, and that trustee, who is the person that the beneficiary, who is the lender, entrusts to follow the instructions of the deed of trust if and when a borrower goes into default. So hypothecation is, just to describe it, is the process of agreeing to use an asset as collateral in exchange for a loan. That is hypothecation. $25. Which of the following correctly describes the flow of money and documents in a mortgage loan transaction? Let me enlarge it a little bit. Oh, that was too much. Which of the following correctly describes the flow of money and documents in a mortgage loan transaction? A, the borrower gives the lender a note and a mortgage in exchange for loan funds. B, the lender gives the borrower a mortgage and receives a note in exchange for loan funds. C, the borrower receives a note in exchange for a mortgage from the lender. D, the lender gives the borrower a note, loan funds, and a mortgage. So remember, a promissory note, who gives that to whom? You know, I promise to pay what I owe you in this many years and this amount of money. And a promissory note does not get recorded. Okay, let's see. I've got A. Anybody else? So, yes, the answer for 25 is A. The borrower gives the lender a note, a promissory note, and a mortgage, okay, in exchange for the loan funds, a deed of trust, right? That is the mortgage that specifies what happens should they be in default, and it describes all the terms of the mortgage. A promissory note discloses the financing terms, how much they're going to pay for how long. So 725A. And, you know, the property is collateral, and the mortgage specifies that that borrower is going to pay the lender. And what happens if they don't? And it can also specify that the lender may sell the note to somebody else. That happened to my mortgage. Okay, so that's it for national questions. We're going to shift into state questions. Oh, better show that. So let me transition. Anybody watching the replay, you can fast forward until you see the state questions coming up. So those of you that were here watching national, hey, thanks for attending. And remember to, hey, tap the thumbs up, okay? Letting me know, send some love that you like this video and that it helps you. If you've never been to my YouTube channel, go to YouTube AgentPrep, tap the subscribe button, click the little bell so you're the first to get notified every time I go live or upload a video or a short, and like this video. And good luck on continuing to study for your exams and for your state from your particular state. All right, so almost done here, shifting into state questions. So we're starting out with question 623, and we're still using the same book. Okay, so anybody that this is the book that we're using. You know, the more people are on the internet and on cell phones, our computers, systems slow down. So this is the book we're using, still on state. And we're starting with 623. Or I should say 1623, which is continuing special topics. You're very welcome. Hi, Jaylene. Hey, she's just on time for state questions. Awesome. $292. You're welcome, Ruth. She needs to pass the national exam. Yes, the national exam. Okay, number 1623, and this is dealing with special topics. Which of the following is an accurate requirement for making a valid will in Texas? A, you don't want to just look at me, you want to look at the text, right? There we go. Making a valid will in Texas. A, the maker may be 17 years old if a member of the military. B, the maker must have a guardian if deemed to be mentally incapable. C, the maker must be 21 years of age. Or D, the will cannot be in the maker's own handwriting. Type your answer in the chat. So far, I have an A. And yes, that answer is correct. The maker may be 17 years old if a member of the military. Very good. Awesome. All right, number 24. Which of the following is true regarding mechanics liens in Texas? Mechanics liens in Texas. A, mechanics liens cannot be filed until there is a delinquency in paying the contractors. B, there is a specific 75-day time limit for recording the lien, statute of limitation, okay? C, the lien only attaches to the specific portion of the building that was built or repaired. Or D, mechanics liens are classified as involuntary in Texas. So which one is the best and correct answer? So far, I've got a B. Okay, who else is here besides Jaylene? Not sure. Yes, the answer is B. There is a specific 75-day time limit for recording the lien. So that's the statute of limitation. And they'll end up providing a document to the homeowner or whoever they're doing mechanics work for or contractor work for, letting them know that, yes, they will be filing a lien if they don't get paid. And it gets attached to the whole property, not just part of the property, right? And mechanics liens cannot be filed until there's a delinquency in paying the contractors. I mean, yes, because how else are you going to know? But there is a 75-day limit. What if they do it 6 months later, a year later? Well, you know, that's past the statute of limitation. And it doesn't attach to only a portion of the building that was being repaired. And then mechanic liens are classified involuntary. No, that owner wanted repairs done. So he volunteered to the loan. I mean, he volunteered to pay. So if they don't pay, there's a lien attached to it that the contractor can put. Number 25. The overriding purpose of the Veterans Land Board is which of the following? The overriding purpose, Veterans Land Board. A, to administer programs designed to assist vets in acquiring their principal residences. B, to partner with VA, Veterans Administration, in underwriting low-income housing veterans. C, to create a forum for appealing rejected loan applications submitted to lenders by veterans. Or D, to assist veterans homeowners in adjudicating foreclosure suits brought by creditors. So the overriding purpose of the Veterans Land Board. Aileen's on the ball here. So you had answered, oh yeah, Fabiola, you answered D to number 24, but the answer was B. Yes, the answer is A, to administer programs designed to assist vets in acquiring their principal residence. And they can only have one VA loan, okay, for a principal residence. Once they sell that, they can apply for another one. And they have to get another certificate of eligibility that then they provide to the lender to let them know this is how much VA will guarantee a loan. Because remember, that's what the certificate of eligibility provides, right? How much money VA is going to loan for that particular veteran. Number 26. I'm out of it today. Yeah, it seems like kind of me too, right? Because I'm doing multiple things, even though I do this 3 times a week. However, I'm looking at all the answers. I'm looking at Facebook, YouTube, the questions, and StreamYard. So, my head is going all over the place. All right, number 26. You're okay, Fabiola. Just keep at it. Jane would like to purchase a property in the Silverleaf subdivision, which is managed by a homeowners association known as HOA, requiring all owners to be members. Okay, it requires all owners to be members. Okay, so that's an absolute. Okay, they do have to be owners, members of the homeowner association. Which of the following is true? A, if Jane is not informed of the HOA prior to closing, Jane can cancel the seller's contract. B, the seller must disclose the HOA requirement prior to taking possession. C, the seller must give written notice of the membership requirement to Jane no more than 7 days after signing the sales contract. Or D, it enables the buyer to remove all liens of the property. All right, so Jaylene's on the ball here. So who else? Type your answer in the chat. Come on. All right. In order for a buyer to follow through with it, they have to receive, okay, the HOA documentation prior to closing. And of course, when they go to a title company, the contract gets taken there. The title company is going to request those documents from be ordered, okay, by the seller, or they will order them and then charge the seller or whoever is required to pay for it. So therefore, the buyer, Jane, can cancel the sales contract and get their earnest money returned. But both parties have to sign that release of earnest money. The option fee, the right to do inspections, that is not returned. Okay. I tell you a little bit more just to kind of remind you of certain things that go along with the contract. She can cancel it and she'll get her earnest money back, but not the option fee. Number 27. Which of the following is a true statement regarding equitable interest? A true statement regarding equitable interest. A. Following the execution of a sales contract and prior to closing, sellers have an equitable interest in title. B. Texas is referred to as a lien theory state. C. Texas mortgages hold equitable title to the collateralized property. Texas mortgagees, not mortgages. Or D. Texas mortgagors hold equitable title in the collateralized property. So type your answer in the chat. Yes, the answer is D. Texas mortgagors, the borrower, hold equitable title in the collateralized property. That is the subject property that they purchased. $16.27 D. And so equitable title, okay, a beneficial interest in real property that gives the title holder the right to acquire legal title to the property. So equitable title holders cannot transfer legal title to real property, right? Because it's controlled by the lender. There's a loan, okay, by it. But they derive benefits from property's appreciation in value because in the meantime, they're paying the mortgage, right? They're using the property. They have all the bundle of rights with the exception of, getting a loan on it because they already have a loan on it, right? So an equitable ownership interest is a form of ownership of or right of use that exists without legal title to the property. For example, a person regarded as the real owner because of his investment in the property, but the legal title is in someone else's name, has an equitable ownership interest. So the lender has the equitable title. Earlier, I think I made a misstatement that the lender has the legal title, and which the equitable title, they have legal title, right? Because the borrower still has to pay for the loan. So the mortgagee holds the legal title until the mortgage is paid off by the mortgagor. So in the meantime, they hold equitable title. They have an interest, a beneficial interest in that property until it's paid off. They can use it, enjoy it. They can restrict anybody from going on it. They can sell it. Okay. They can encumber it only if they have lots of equity in it. Okay. So let's see some other things here. See, equitable interest arise where there is an interest in a property. So that's the borrower. They have an interest in the property. Albeit the party with the interest does not have legal title. Legal title is the true and enforceable ownership of a property. So the lender has the true enforceable ownership of that property with the deed of trust or the mortgage should the borrower default. Okay. Let's see. Wait, we are a lien or title theory. So what do you think? I think we had this question. So Texas is a title theory state. This means that the title for the property stays in trust pending the complete payment of the deed. So we have a deed of trust and the trustee holds on to the title. and follows the instructions of the deed of trust should that borrower default. So we're a title theory state. So let's see an example of a lien theory state. So states like South Carolina, Florida, Louisiana, Arkansas, New Mexico. So there are a lot of lien theory states. So hold on here. I'm Googling it, okay? That's where I'm reading. So I love to Google, to know the difference. So lien theory state, there's actually less lien theory states. Okay, there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. So there's like 20 lien theory states. Most of the West Coast and Texas and some of the southern eastern states are title states. Okay, and I wanted to give you a little bit of a quick description of the difference. So whenever you're in doubt of something, hey, quickly Google it, okay, and see the difference. So in a lien theory state, the buyer, who is also the borrower, right there, the mortgagor, will hold the deed to the real estate property for the life of the mortgage. So in Texas, the borrower holds the deed. However, there's a vendor's lien that shows up on the warranty deed. So the buyer promises to make payments on the mortgage according to the terms spelled out in the financing agreement. So in Texas, that's a promissory note, right? In most states. So then the mortgage agreement serves as the lender's lien on the property until the loan is paid back completely. So that's in a mortgage state. So in the deed of trust, okay, it mentions that there's a loan that the borrower has to pay, and it's also specified and listed on the warranty deed. So it'll say warranty deed with vendor's lien. That way, the borrower has to pay that loan before that lien is removed, and has to request and make sure they request the lien release from the lender, because sometimes the lenders don't provide it. So let's see what else. So this is in a lien theory state, right? The mortgage agreement serves as the lender's lien on the property until the loan is paid back completely, but the buyer holds the title to the property instead of the lender. We're a deed of trust state. Okay, so we are a title theory. So the title stays with the trustee when there's a deed of trust. And the lien is extinguished when the loan is paid off in full. The same as with a deed of trust in the state of Texas. Okay, once the loan is paid off, the lien is extinguished. In a theory state, title theory, in these jurisdictions, lenders convey the title to the buyer, who will then issue a deed of trust, right? And the deed of trust has 3 parties, naming the lender or mortgagee as the beneficiary of the trust. And the trustee holds on to the title, and they follow with the instructions of the deed of trust in case a buyer defaults. The title to the property is held by a third party, that is the trustee, who is given the power to foreclose should the buyer fail to comply with the terms of the mortgage agreement. So actually, I should show it to you, right? I just have to move it. All right, so let me enlarge this. So it's, when in doubt, hey, Google it, okay? So title theory states. So see, a lot of them are on the West Coast and some are in the East Coast. And those are deed of trust states. See, deed of conveyance. So when the loan is completely satisfied, the lender issues and records a deed of reconveyance and a release of liens. So rights of ownership and possession reside with the buyer according to the terms of the deed of trust. So ownership and possession and enjoyment. And what's the other one that they can prevent individuals from coming to their property, right? They have the bundle of rights, except to convey the title without informing the lender, okay? They can convey the title, but in a sale. So when there's a title theory, we have a deed of trust. When there's a lien theory, it's a mortgage, okay? And there's probably a 60, 30, 20 ratio in the 50 states, something like that. So thank you. This clears up a lot. Yes. So the trustee keeps the title in a deed of trust state, which Texas is. And in a title, in a lien theory, the buyer keeps the title, but they still have to pay the mortgage. And that is called a mortgage, right? A real estate property for the life of the mortgage versus a deed of trust. Okay. And a deed of trust, it's a non-judicial foreclosure, meaning the trustee will just follow the instructions that are in the deed of trust to start the foreclosure process and send out notices, right, of a foreclosure starting. In a lien theory state, and there's a mortgage, that is a judicial foreclosure. They have to go to the judge. Mortgage, judge. Deed of trust, no judge, non-judicial. So that's what judicial, non-judicial mean. Judicial means they have to go to the court and get a judgment to sell the property in foreclosure. That's with mortgages. That's with lien theory. With title theory, it's a deed of trust. Title stays with the trustee. Okay. And the deed of trust provides a non-judicial foreclosure. No judge. All right. So we got it, right? And I'll tell you what, y'all, I mean, this refreshes a lot of that information for myself too when I research it, because we don't use a lot of this information. Okay. We're sales individuals that are helping sellers sell their property by bringing a ready, willing, and able buyer. Doesn't mean that we procure the buyer, but we might. Any other realtor can bring the buyer. So our responsibility to the seller is to bring a ready, willing, and able buyer. Okay. And on the buying side is to help them find a home that meets their requirements and keep them focused on their parameters, the loan amount. Okay. Guide them through a lender to get pre-approved. Okay. You're going to learn all this once you get started. And you think this is the toughest part about real estate? Passing the exams, it's actually the easier part of real estate. It's like going to college, okay? You've got to pass your exams. Once you pass your exams, do you know everything? No. You're going to learn it out in the field, and you're going to do it, and you're going to keep studying more. Going through training classes, okay, guidance through the broker, other realtors, taking action, doing the activities. That's how we're going to learn it. We get a lot of education and training and coaching once we're out in the real world and networking with other realtors and agencies and getting along with other realtors, right? Because we never know when we're going to work with them, and we want to respect everyone. Okay, y'all. Any questions? Remember, study, study, study. Lots and lots and lots of questions. And the vocabulary is crucial. It's primary, okay? Vocabulary, vocabulary, vocabulary. You're learning the language of real estate, okay? Real estate. We are realtors, not realtor, realtors. Two syllables, realtor. Okay, so learn those vocabulary. Memorize them if that's easier for you, okay? Memorize the vocabulary. You repeat the questions over and over and over so that you recognize them really quick when it comes down to the exam. And don't expect identical questions on the actual exam. You might have some, okay, especially from older books. However, do not expect that. You're going to get questions that you've never heard of the material, you've never heard of the words, you've never heard of the situations. They want us to think, okay? To think on our feet, think on our own, and use common sense. All right, y'all. I'm also with the active realtor with real estate. And guess what, man? Right now, I'm sending out letters to expireds every single day. I'm sitting here printing them, filling them out, signing them, stuffing them into envelope, putting labels, handwriting the addresses, and delivering them every day. Why? Because the market has changed, has started changing, and there are more expired listings now than there were during the market being heavy duty sellers market and multiple offers. Well, that's not the situation. Yes, some properties are still having multiple offers, but many are not. There's lots of price reductions, and now properties are on the market 3 months, 6 months, and expiring. So this is the perfect time to go after expired listings. And of course, always for sell by owners. So I'm doing those. Those are what I enjoy doing. Okay. So y'all, until next time, catch you later. And when is next time? Saturday morning, 10 o'clock a.m. And keep watching videos. Catch y'all later. Love ya.